Okay, hello to everyone who's just arriving now. We're just going to give it a couple more minutes. If you can hear me properly, if you could just type in the question or chat window the markets that you are currently trading or looking to trade. Fantastic. Okay, we'll give it 2 more minutes and then we'll get started. Those of you who are coming in now, if you could just let me know that you can hear us properly, just in the question or chat section, if you could just write the markets that you're interested in trading or currently trading at the moment. Thanks.
I just received a message saying they registered but didn't get a link to join.
They all should have been emailed a link. Yep. But if you want to send them a link, I can send you something through. Do you want a link there, Philip? Excuse me,
Yeah,
guys.
please. Yeah, please, because a lot of people are saying they didn't receive an email.
Okay, yeah, well, they all should have got one. Bear with us, guys, as we iron out a few technical. I just sent you in the chat. You should see an invitation and a link there, so you can send that through to everyone.
Okay, perfect.
Okay. All right, so I think what we'll do is we will get started, and this will be recorded so those who come a little bit late can catch up at a later stage with our on-demand version. So firstly, those of you who don't know me, I'm Julian Allen. I'm the Director of Traders Success at FairMarkets. At FairMarkets, we really strive to give traders the insights, education, tools, and support they need to master and maintain an edge on the market. Tonight is a super exciting event for us as we present a trader and an educator, Philip Salum. Did I get that right, Philip?
Yeah, that's right.
Okay. Philip utilizes liquidity and volume to get an edge in the markets. He graduated in medical school and radiation science, however, found his true passion back in 2016 when he started fiddling around in the cryptocurrency markets. He's always believed that the true meaning of freedom is time, not money. Philip he's obviously followed his passion in trading. He's the founder of Opus Trading Group, and Opus comes from the Latin word meaning wealth. He stresses that Forex is by no means a get-rich-quick scheme and should not be treated as one, but with the right ingredients, practice and diligence, you can definitely make this an income for yourself. So without further ado, I am going to hand over to Philip as the host, and we can get started in this super exciting event.
Thank you.
No probs. Here we go. Oh, actually, sorry, before I do that, I'll just take you through a little disclaimer. Just bear with me one sec. I'll bring that up. Really being put to the technical test here. So this is our disclaimer. A funny story. Disclaimer is a statement that denies something, especially responsibility. So heed the warning. The material tonight is general advice only. We don't know who you are. So if you are thinking of acting on this, please see a specialist or do your research and evaluate the risks that you may be taking on. The examples provided in the presentation are examples only, and future financial performance may vary from any historical performance that you see. I'm sure you know this, but when you trade with our products, there's leverage, and this amplifies both profits and losses, and many of our trading products offer leverage. All right, now I can hand over to Philip, and we can get into the good stuff.
Thank you.
All right, Philip, you should have the conch. Did I do the right person?
Yep, that's it. And I'm going to have to do my little bit now and just show my my disclaimer there. So it's pretty much the same thing. And I'll get started right into it. Okay, so today's topic is liquidity and volume. And when I first started trading, I fiddled around the crypto market, found my way into the FX market. And when I found my way into the FX market, as any trader would, you start off by testing out so many different techniques, so many different indicators and styles of trading until you really perfect that one style and that one strategy that's going to really give you an edge in the markets. After years of trial and error, I have come to the understanding that volume and liquidity are truly my edge in the markets. And I'm here to share some little tips and some great knowledge and information that could help you in your trading. So what I have found over the years is I've been trading the pound pairs quite a lot over the years. I've also actually been trading a lot of the cryptocurrencies, especially BTC. Now, I have refined the strategy down and found that the British pound against the US dollar is what my strategy and the style of trading that I look at works best on. So firstly, I want to explain what volume is. In terms of volume, it is the exchange being transacted between two people. So we have to really understand what CFD trading is and what the markets and the way they operate. So in the markets, for every buyer, we need to have a seller, and for every seller, we need to have a buyer. So we are trading CFDs, which are contracts for difference, meaning when you want to take a buy in the markets, there has to be someone on the opposite end that's going to give you that contract. And it's the same in the opposite way. So there needs to be a person in the opposite way to give you that contract so you can then enter into the markets. Now, I like to look at the markets as, you could say, this one big organism where it's always trying to find its balance and balance itself out, because when you've got too much buyers on one end, there needs to be that whole bunch of sellers that needs to come in to balance the markets. And it's almost like volume is just this whole balancing of these contracts at all times. So there's also a big misconception with people, especially beginners that are getting into trading. When they hear the word volume, they typically think that when the market is moving very, very strong with momentum into one direction, that means that's considered high volume. However, that is not correct. So high volume is actually found in consolidations. So I'm just going to do a little demonstration of that before we go ahead and talk about different things. So if I go into my little indicators, I grab the fixed range volume profile. That's just going to show you the volume that I'm displaying. So if I just take it from this point here, this candle right there, and I take it down into here. So as you can see, the market ran down with a lot of momentum down here, and then we found the consolidation of the price down here. So if we look at this down to here, that's a perfect display of how when the market is moving with strong momentum, it's actually little volume. And why that is because we need to understand how these contracts are actually being transacted. When the market is moving very strong in that one direction, what it actually means is that all these sellers have no buyers on the opposite end taking their contracts. There is no fight between the buyers and the sellers. The sellers are ultimately winning the fight, and they're pushing the price right down because these contracts need to be filled. Now, if there is no buyer at this level, what is the price going to do? And what's the market going to do? It's going to jump down to find the next buyer, and it's going to fill the orders at that point. And it's going to keep going down, filling the orders. So the more sellers, the stronger the sellers are. What that's going to do is it's going to keep filling these orders all the way down until it finds a point where there's going to be somewhat of a little battle where the buyers can come in. And as you can see, as soon as we found a little bit of a resistance from these sellers, which is right here where we started finding these wicks, and we found another wick here, you can see that buildup of volume that began to happen. Now, where is the volume the highest? The volume's the highest, and it's almost like a tug of war between buyers and sellers. Volume is the highest in these consolidations down here. And as you can see, that was the highest amount of volume. So the most transactions that happened, and as you can imagine now why, because there's buyers and sellers, and the market is just indecisive because there is an equal amount, and that tug of war is just very, very fair and even. And that's why there was the most amount of volume transacted right here. So this is the first point I want to make to any traders, especially beginners. High volume does not mean when the market is moving in one direction. It is found in consolidations when there are buyers and the sellers are fighting each other. So now that we understand that, I want to actually take you into another example to describe the volume. So if I was to just draw a little example here. And now I want to come and tie in the aspect of volume and liquidity. So what is liquidity? Liquidity is pretty much where contracts are lying. So as we know, people are not just market buying and selling in these contracts. So it's not all live buying and selling. There are what's called the pending contracts, and all the pending contracts are pretty much contracts that are going to be filled at a future date from when placed. Large institutions and large banks put in these pending contracts for future dates where certain levels they want to buy or sell at. And once these certain levels are reached, that's when their contracts are open. Now, I want you to look at a typical consolidation like this. Now, when we look at the typical consolidation like this, we know that the buyers and the sellers have an even fight here. There's a lot of volume in this at this point right there. And as soon as the buyers come up, the sellers meet them and drag them back down. Then the buyers meet them and drag them back up. Now, typically in this over here, in this consolidation over here, what we're going to look at is the liquidity. So stop losses, for those of you that understand, stop losses act as liquidity. So when we look at this consolidation, and then I'm just going to draw a little horizontal ray up here, and I'm going to put one down here. So the longer this consolidation is going for, the more liquidity is building on either side of this consolidation. Now, what does that typically mean? If you look at a consolidation, a lot of people, if they are entering the buys from here, their stop losses are placed below that range. When people are taking sells from up here, what is happening is these sellers are typically placing their stop losses above that range. Now, large banks and financial institutions that are in the markets and trading the markets, you got to understand you got to typically understand how the big players are working in order to have an edge in the markets. Because if you don't understand them, and if you can't follow in their in their shadows and in their footsteps, you're going to be at a disadvantage, because they are ultimately the large enough players that can move the markets. So now if we look here, and let's say we have a bank that's typically looking at taking, let's say, a $50 million short position on the pound USD. Now we know if they enter that position all at once, what is going to happen is there's not going to be enough orders and contracts to fulfill all these sell orders. And what's going to happen is the market is typically just going to crash all at once. So what's done is you got to look at it in the sense of they enter a bit of their position up here and they let the market move down, then it will move back up. Then they enter another bit of their position up here. Then they enter another bit of their position up here until they are almost satisfied with their complete position. And what that is doing, you got to understand, when you are placing large contracts of that nature in the markets, you want to have the best prices possible. Meaning you don't want to sell up here and get your orders fulfilled as it's going down, because there are no buyers on the opposite end and you're getting your sells fulfilled at lower levels. You want your sells to be fulfilled at the best levels and at the highest price if you're aiming to go short. So then what we're going to look at as well is the concept of the liquidity now. Now, liquidity is these stop losses on either end. Why? Because these stop losses are orders in themselves. The market is going to be attracted to these orders because if there's orders there, there's liquidity. And how many times have you guys noticed in the markets that you'll be looking at a range, then you'll see something like this? So before I go any further, what this point right here has done is we have moved to the upside. And you've got to remember, all these large institutions and banks, their stop losses are not trading with extremely tight stop losses. They're not getting their positions knocked out with such a small move. What's happening here is all these sellers' stop losses that are acting as liquidity, because their stop losses are ultimately, when you get stopped out of, let's say you're short and your stop loss gets stopped out, there's someone else taking a short position. You are ultimately giving it to them, because a short seller's stop loss is ultimately a buy order that's going to be given to a seller at this point. So now what that's done is two things. And these two things are the shortest stop losses have been taken out, and you're going to have a lot of people that are going to say these highs were broken and they have buy stops above these areas. So that's another reason for the liquidity pool that's adding up, that's building up. And then you're going to have the short sellers that were here that said, we broke the range and now we're going to go into bias. So all these things are happening. And then what we will notice is this will happen. Now, I know almost every single one of you has, if not experienced, seen this happen in the markets with them. And this point right there is what we call the liquidity trap, the liquidity grab up here. And this in itself up here was all a liquidity pool. So liquidity pool, you got to notice, I want you to get into the way of thinking, the chain of thinking of where is everybody placing their stop losses? Because everybody's taught a certain way of trading when they first start. And if it was successful, every single person will be succeeding in their trading. And the market is going to be attracted to these stop losses. So start thinking in the perspective of where is everyone placing their stop losses? If we have a range, everyone's stop losses are going to be placed on either end. So that's going to tell you there is a liquidity pool sitting above and below these regions. Another misconception is that you shouldn't be trading consolidations. You should be trading the momentum when the market's moving. You shouldn't be trading, I would say, the consolidations when you don't want to find yourself stuck, I would say, in consolidations. However, when you have these certain scenarios play out, and if you can see and start understanding these concepts for yourself, and you can make a decision, you can actually start finding that you're understanding these concepts and they are helping you succeed in your trading. So now that this point has moved up and down, what's happened here is all these sellers have been knocked out. These buyers are thinking that their trade is going into the right direction. What are they going to do? They're going to move, the buyers are going to move their stop losses, let's say, into break even. Some of them aren't. Whatever they do, that's all still acting as liquidity. All these orders are still acting as liquidity. Now, the banks and the big players, they're finding this as one final opportunity to fulfill their orders at even better prices. If that makes sense. So you got to look at it as they broke up their position, their very large position, by entering at this point, at this point, at this point. And they have now found an even better position to take their final bit before allowing the market to move into that direction. And when that market, when you find that these prices have been taken out, you got all that liquidity sitting there, they have so much on the opposite end to fulfill their contracts, and they can now move into that direction. And then you get this very strong move because the buyers, there is no more buyers on the opposite end. So you're finding that the sellers are that strong that they can push the market right down. So that's a little description of the volume and the liquidity. And what I want to do is actually show you these things and how they work in the markets. So I want to look at the pound USD, which is, like I described, what I trade and what I look at. Now, I want to point out a few things on the chart that I want you guys to understand. If we look up here, that's firstly on the monthly. I'm going to do a bit of a top-down analysis, which is ultimately looking at the charts from the highest time frames and working ourselves down so we can understand the markets the best. So if we look at here, and we look at this point right there and this point right there. So we have what we call these equal highs or a double top. Now, a lot of people, what they do is they look at these as resistance levels and they look at shorting from these points, let's say, because it's a resistance. And then you get exactly what I just described to you, the liquidity right there. So that was in itself the liquidity grab. And now you have an understanding, and you can see it from on a live market, you could say from a market perspective, what I just demonstrated. So if you have the high right there, the high right there, all these people are anticipating that the market's going to find a resistance at this point and bounce back down. So where is everybody's stop losses? They're going to be placing stop losses, a whole bunch of stop losses above that resistance point right there. So that is going to be that liquidity pool that's sitting right there. So a liquidity pool is just a whole bunch of orders waiting there. Okay. And then the market is going to move down, and that in itself was a liquidity grab. Then I want to point out this point right here. And this was an interesting point because I'm going to show you what it demonstrates. So we have that point there from November, December 16. Then we have another point from August 2019. We have these equal lows right there. And we see this massive wick to the downside on the monthly time frame. And then the market came back up. So we can see no candle bodies actually closed below these bodies there or these bodies there. And this in itself right there was a liquidity grab from the market, where liquidity was grabbed to move the market back to the upside. Interestingly enough, this candle right there, if we look at when it happened, that was March 2020. March 2020 is the COVID month where COVID pretty much began and affected the markets. And this was a perfect opportunity for the market to come to the downside, fulfill all these orders that were sitting below these lows of these wicks right there, grab all that liquidity that would have been sitting there. Now, an average person or let's say a trader is going to be looking at this saying we broke the lows, and they're going to be looking at shorts. They're going to look at shorting the market. They're going to even maybe be waiting for a retest of these lows to then short. However, what we can see is the monthly closed all the way back up and found the market coming right back up to here. We can even look at this point right there, and you'll start spotting these everywhere. Right there, where you can say 1, 2, then the liquidity grab came back in, then the true move to the upside happened. Another thing I wanted to also describe that could help a lot of you guys in your trading is when you're looking at areas of support, resistance, and especially the supply and demands. If we have a market that's doing this, now let's say we can say that there's a supply area right there where there's going to be orders in that region, and we can maybe anticipate some sort of a break or a resistance before we can break. So I want you to look at the volume in these demand areas in this way. Many people actually think that the more you tap into an area, the stronger the resistance is. I believe that may not be completely true. And the reason for that is I'm going to demonstrate it from, whoops. What did I do? Okay. I'm going to demonstrate it from a volume perspective. Let's say there's a certain amount of orders sitting in this region. Let's just make the number 100. And we come into this area right here, and we get a strong reaction from that point. Now, let's say out of those 100 orders, we've taken out half of them. So we're left with 50. Now, when we come back into this area, you got to remember that wall of sellers that we're running into as buyers is going to be less because now it's halved, right? So when you're coming up to it, it's almost like you're just hitting a wall over and over again. Every time you hit it, you're actually weakening that wall. So once you come in for a second time, you might find that weaker for that second time. So the rejection you get might not be as strong as the first one. And now you're left with, let's say, 20. And if the buyers are strong enough, hence why you'll notice that you'll just go right through. So this point right there and this point right there will what weakened that seller's wall from a volume perspective in order to go right through it. So that's also important to kind of grasp and understand that the more a support or resistance is getting tapped, the way I look at it is the weaker it is becoming due to the fact that the volume in there is diminishing. So back to the pound USD. Now I want to point out back to the monthly, and if I remove these drawings just for a sec, that wick in there is also going to carry a lot of liquidity of its own within it. So when the market comes back down, we're going to see a lot of orders that were missed due to the very, very big momentum that happened in there. A lot of orders get missed, and the market wants to come back to rebalance these orders. So what we're going to notice is if we look at this week, and I'm going to kind of just look at it from a perspective of we have now hit almost half of it, and we've fulfilled a lot of orders sitting within it. So now when we go down to that weekly time frame, what we can notice is we are down into this area, which is a demand area. Another thing I want you to look at is my volume indicator down here. So ultimately, all this is saying is these spikes are showing me the high volume candles. So I can see that this candle right there, that bearish candle, carried a lot of volume within it, meaning there was a lot of contracts transacted in that candle. And that's important to me because I can now see that there's going to be a lot of volume meaning I can find support or resistance in that candle. Now moving down to the daily time frame. Once again, if we go back to that point, we can see that this in itself is a massive demand area. Why? Because it carries a lot of volume. And if we can go back to here, we can see how the market found a bounce at this point and is, it's finding a support in this region. As you can see, the market moved very, very strongly to the downside, and we're now finding somewhat of a support there. And if we come to this point right here, so we've got a lot of orders, a lot of volume in this candle right there on the daily. So now if I look at that specific candle with very high volume, and it's this bullish candle, oops, right there. So this bullish candle right there. Now this candle is going to be acting as a supply candle for me from a daily perspective. Why? Because I know that there is so much volume sitting within that candle that once we came to the downside, you can see we did create a lower low. So we are showing that we are trending to the downside. So if we look at it from a daily perspective, we are trading to the downside. Pound USD is trending to the downside. It is always important to remember your higher time frames and how we are moving from a higher time frame perspective. So we can see we've got lower lows, lower highs. At this point, we created a lower low. And at this point, as we're coming back up, we are anticipating a lower high or just some form of a resistance. Now, these liquidity grabs don't just happen in consolidations. They don't just have to happen in a horizontal perspective. Looking at a channel moving to the downside. So I remember when I first started trading, I looked at a channel, I looked at 0.1, 0.2, and I was looking for that 0.3 touch in order to short from that point, because that's what I believed. I believed that the market and these trend lines were always going to work. They do work. However, there are times when they don't. And the times when they don't, this is what I'm trying to demonstrate for you, is these are those liquidity traps and liquidity pools. So moving down from this channel, you can see at this point, the market did find a rejection. It tapped that trend line in this specific candle right there and moved to the downside. Then we had this bearish doji. This would have led a lot of people to think that the market is actually rejecting the channel. However, I looked at it from the perspective where I knew there's a big demand candle, and I'm going to show you how there's a smaller demand candle when you narrow it down on the smaller time frames. And I knew that we could potentially move up to fulfill these orders because orders want to be fulfilled, right? There's a big liquidity pool sitting above there. Now, what do you see? You see one bullish candle, and this psychologically what it's going to do, it's going to drive all these sellers to think, I was wrong, the channel's broken, we're now going to the upside, only to be followed by a massive bearish candle that engulfed the previous one, and we are now moving back to the downside. So what's all this telling me? All this is telling me that this whole region here above that channel was a liquidity pool. And now what I'm going to do is I'm also going to line that up with my supply and demand areas to further and to be more precise, you could say, in trying to find exactly where those liquidity pools are sitting. So I'll go down to the 4-hour time frame, and I can narrow down my, you could say, my supply area to this region right here. And why this region right here, I could say, because I can see there's a massive bearish candle right there. Massive bearish candle. And if I was to measure that candle, that's a 75 pip candle. A 75 pip candle is a fairly large candle. It carries a lot of volume within it. There needed to be a serious amount of orders in order to push that candle 75 pips, meaning the candle there, where that move started, has a lot of volume sitting there. And this is why I saw that the market was a point that it could reach. And now as we're going down in time frames, you're also going to notice that these aspects that I was showing you before are going to appear on an even smaller time frame. So if you look at this high right there and this high right there, we created these equal highs, massive wick to the upside. What's that going to do? It's going to drive a lot of people into thinking this is the short that's going to happen. However, once again, what do we have? We have a liquidity pool that's sitting above here. And the market found its way up here. As you can see, massive bullish candles, only to stop at this point specifically and turn back around. Okay, sorry, I don't know what happened. Okay. So now what I'm going to do is I'm going to introduce a little indicator, which I really like. I believe many of you guys would have seen me use it through my social medias and my groups. So if you go to your indicators on TradingView, there's a session volume profile HD. I want to show you guys, this is something I'm going to share with you on how I utilize it to improve my trading. So if I turn that on, ultimately what the session volume profile HD is going to do is it's going to show you session by session. So from the open of the trading day until the close of the trading day. And it's going to show you where the most amount of volume was taken in that session and in that day. And that red line is known as the POC. POC standing for point of control. So that was the highest amount of volume for that day that was taken. Now, another thing I want to show you that's interesting, and I don't want to confuse you too much, but within that area, you can see we've got a POC that's sitting right there, meaning that's another reason why I saw that market is going to be attracted into coming up to this area, fulfilling all these orders before moving back to the downside. Because ultimately, I'm looking for a bigger time frame. From a bigger time frame, I'm looking at a short bias. Why? Because the larger time frames are telling me we are moving to the downside. So by doing that, I'm remembering in the back of my head that ultimately, yes, and I have this trend line up here to show you that this is the counter trend. This is the retracement, perhaps before the next impulse. Because as long as we are moving to the downside, as long as we're creating lower lows, in the back of my head, we are in a short bias. So I looked at this point here. There's a lot of people going to be shorting from this point. We have that volume. We have a point of control. And this is the area that I want to look at. So now that we've done that, I want to show you guys also another thing. So this is something that I do on my smaller timeframes and on my 30-minute time frame. So if I go onto my 30-minute time frame, and I want you guys to look at the volume down the bottom, and I want you to pay very careful to these spikes in the volume. So I want you to pay attention to big spikes in the volume because they are going to tell you something. Now, if I look at, let's say we start from here, we've got a big spike in the volume at this point. And I look at it and it was actually a massive bullish candle to the upside. So now I look at that candle on the 30-minute and I look at specifically at that candle, what happened after it. Did the candle continue on? Did the volume that it had allow it to continue that momentum, or did it stop pretty much with that candle or shortly after and come back? At this point, you can see we stopped and we came back. So at this point, what I'm going to do is I'm going to put a horizontal line at the base of that candle where the volume pretty much kicked off from. And that can now act as a point of interest for me. So what you can see, when the market came back, that was a point of interest, point of interest, point of interest, and point of interest again. Now let's look at another massive volume spike. So if we look at this candle right there, so that was a bearish candle, and that was this specific candle right here. Now, if I look at this candle right here, the market didn't really continue with momentum, didn't really push down. So I'm going to put it from the top of the candle body. And once again, I had a point of interest that further went onto the chart. Interestingly enough, I'll show you something else. It wasn't just this point there, because once we break through it, I'm not really looking at it much more. Once again, we had a bit bullish candle right there. The market didn't continue. And then from the low of the body, you can see how it was a point of interest right there. So these candle volume spikes are actually helping me a lot in looking and analyzing my chart. This specific massive candle spike, we can see massive volume, candle spike to the upside, but it wasn't followed by any further momentum. I get it from the body right there. And you can see how accurately the market came back to grab the liquidity from that area of volume before moving ahead. So these are little tips and tricks, you could say, that I use in my volume and with my volume and liquidity in order to understand the markets a lot more. Obviously, I've got a lot more ways and a lot more in-depth analysis where I can use my volume and liquidity to analyze these markets. However, these are just little things that I want to share with you guys that I truly believe, especially if you are a beginner, even if you're an intermediate or an advanced trader, if you can apply and add these things into your trading, they could be of great help, because they can help you see things for what they really are. A lot of people, what they do is they forget that these candles actually represent people, because every candle and every candle movement is representing real people behind it. They are not just candles on a chart. A candle is representing a buyer, a seller. It's representing the strength of buyers and sellers. So when people ignore volume, it doesn't make sense to me, because at the core basis of it, all candles are a volume, and all candles is just buyers against sellers. So if you can understand where these pools of buyers and sellers and the liquidity is pretty much lying, it can help you dramatically to understand and see the charts with a much clearer picture. So that's pretty much it. I really do hope that you guys understood everything I was talking about. I am going to allow you guys to ask me any questions so I can, help answer them, help you understand further what I was talking about. Before we get into the questions, I want you guys to just firstly in the chat, just let me know what you thought. Let me know if everything was truly understood, if everything made sense, if there was anything you want me to go over a second time, and then we can get into the questions. All right. Goes lower, hitting the buy stops, hitting the sell stop. Yeah. The part where you mentioned it went above the trend line to grab liquidity. Okay, so all that point was if you remember how I was describing that the market will move into a consolidation, then it will grab liquidity from one end, then move into the opposite end. Same thing goes with a trend line. So you got to imagine that the trend line is that consolidation where you got the market here. And then what happens is that break above it right there, that's that liquidity grab. That's where these sellers are getting even better prices to take their shorts before the market moves to the downside. Can you explain one more time how you use the PHD indicator? Do you mean the volume indicator? Okay.
Sorry, Philip, it's Julian. Can you hear me?
Yep.
Yep. Yeah, that volume indicator is very interesting. Is that something that anyone can access, or is that a custom?
Yeah, so I believe that you just got to have some sort of a subscription to TradingView. I don't think it's offered to the free TradingView members. However, when you do, you just click on indicators. Then all you got to do is just type in session volume profile HD, and you'll be able to find that. So they've actually recently put these in, I believe around 6 months ago. So all you got to do is just add it in, press it. You don't have to do anything to it. It's already set the way it's set. The point of control, everything about it is set the way it's set. Now someone's asking me to explain how do I utilize it. So I want you to understand that these sessions, so if that's a certain day and there's a high volume, there's a point of contact right here. So that you can see there's a high amount of volume. If you look at the histogram behind it, so that's that point right there. So that's the volume for that day. As you can see, when that massive candle shot to the upside, there was little to no volume. All the bulk of the volume was in the consolidation. So if I look and move to the right side, we can see that once we came back to it at this point, now that was last Friday. That candle right there was news driven. That was the NFP for the US. So that was the employment change. So that was news driven. You're going to find that, yes, it might have broke slightly below it, but that was because it was news driven. However, once we came and found that these candles met these large amount of volumes sitting from back then, you can see how the market found and bounced its way from that point back to the upside. Now, a trade that I took with my group yesterday was from this area to the downside. One of my confluences came from that high volume area right here. And that was the reason I took it. And my students, the ones that did take it and seen it, they'll understand why it was taken from there. The market at the moment, I'm seeing it driving back up to the upside. Why? And this is something that, it's just a little observation of mine, is that we didn't quite go into the high volume areas yesterday. We'd also got a lot of volume from here. So if we look at the histograms, so I'm perhaps maybe looking that we're going to have a lot of liquidity above that wick as well. Everyone's going to be anticipating maybe a double top here. Maybe we can find a grab of these orders from the upside before moving down, as we are only Tuesday for the week. So I hope this cleared up the explanation on how I use the volume.
Philip, could I go a bit further on that example there? Because that's
sure.
really interesting. So I'm looking at, that's obviously the 30-minute, and on your lows, you're obviously seeing slightly higher lows. What is to say that price couldn't break to the upside? And how do you get that conviction on direction, and if it's going to be a trap or if it's going to be a continuation of the trend?
Yeah, great question. So I firstly have to remember I am on the 30-minute. So whenever I'm unsure, I jump right back to the daily time frame. And now when I go back to the daily time frame, I'm going to just turn that off so we can see a bit clearer. I'm just going to remember that we did hit a key supply area and move to the downside. And also that trend line that was moving to the upside, we actually also did break it. So I remember that from a higher time frame perspective, we are trending to the downside until the market shows us otherwise. So for now, I'm actually looking at the market being bearish. So, and the fact that we hit that key supply area right there at that point is the reason why I'm thinking we're going to always be grabbing liquidity from above and moving back down. Whereas if we were trading in an uptrend, I'd always be looking at it in the sense of liquidity is going to be grabbed from below areas to move back to the upside.
Gotcha.
So moving back into smaller time frames, and I'll turn my drawings back on. I look at this point right here. So that was the point that broke above that channel. And that was that, a big bullish move where we met that supply area there and we moved back down. Now, one thing I noticed is we actually broke this point. So that's showing me that whatever this was has actually now shifted back into this. That's why. So it's obviously trading is all probabilities. We just try and put the probability in our favor. That's all it is. We don't know what's going to happen. But what I'm kind of looking at is as long as the market's showing me that we have now shifted into this kind of lower high perspective, I'm just going to look at it from that way.
Gotcha.
All right, let me keep going with these questions. Giving me a completely different perspective on key zones. Everything was great to take in. Thank you, really appreciate it. For a breakdown, liquidity grabs PSC, also creating PI, volume spike candles, knowledge gem. Now we know how you got the accurate entries and turnaround. Thank you. Okay, so I believe there is no more questions. If you guys, I'm happy to stay for another couple minutes or so. If there is something you guys wanted to understand further, I'm more than happy to answer it for you guys now.
While we wait, Philip, I really would like to take the opportunity on behalf of FairMarkets to thank you. I've got to say the way you deliver the content did explain things in a very different way to me. I'm also a trader too, have a real passion for the market. So just understanding, I guess, how breaks through consolidation can actually be liquidity grabs and come back down in the direction of the trend, and just understanding the mechanics and I guess the relationship between that liquidity and volume was very insightful. So I'd like to thank you. You definitely kept me interested.
No worries. Thank you. I really appreciate you having me on here and giving me the opportunity to share this information and knowledge.
That's great.
What about your discipline in cutting a trade when it feels wrong? You've shown you're quite quick to change when it feels wrong. Yes, it's the concept of I never marry a trade. So I never want to believe that I am right and the market is wrong, because the reality is the market will very quickly humble you and it will tell you, no, it's not what you think. And like I said, I'm in a short bias on GU until the market shows me otherwise. And that's talking from a high time frame or a lower time frame. Whatever I'm looking at is I have to accept that I do not control the market. I do not control the future. And I simply, me as a trader, I'm even less than a drop in the ocean in these markets. So I have no input to move the markets in any way. Once you truly understand that, that will help you in changing your bias and following what the market is telling you, rather than what your ego and what your mind is pretty much telling you.
That's great.
Elaborate what you're looking for. Price not moving. What are you looking for other than price not moving in the direction you've entered? What are you looking for other than the price not moving in the direction you've entered?
Maybe
in terms of when I cut a trade wrong, I believe.
Yeah.
Yeah. If it's pretty much, I have, obviously, I'm not giving you guys everything in the way I trade. And that also comes with a lot of experience. Also, there's things that I simply cannot teach in a way, because it has to come with experience. But I have a lot of, you could say, further indicators, and I don't really use too many indicators, but I would say I have a lot of indicators, and it's more price action also. That's why I said it comes with experience. That's what truly gives me that, you could say, the intuition into knowing when a trade might not be the right trade and when it's turning around the wrong way. And that's when I do cut it short or cut it at break even. Yeah. So I believe this webinar is also recorded. So if you guys want to go back and study or understand the information further, I'm also happy to answer your guys any questions you guys have at a later date. If you guys want to find me on my social medias or just simply on my email. Enjoying with the recording will be sent via email to all the registrants.
Yeah, sure. If you like, we could definitely arrange that. That's no problem. And
just however it is, it will be there for those listening, and you guys will get access to it.
Yep. And keep an eye on our website, because we'll be posting a lot of these up once we get the page finished. So
Yep.
That was great.
Thank you.
Thank you again, Philip.
Thank you. Thanks for having me.
All right.
All right. Thanks, guys. Thanks for listening.
Yeah. Thanks, everyone. Have a good night or morning, wherever you are. Cheers.
Thank you.
Bye.